Hi, I'm Seth Freudberg. I'm the Director of Options Training here at SMBU in Manhattan. I'm also the head trader of SMB Capital's Options Trading Desk. So today I'd like to talk about something that came up in a mentoring session this past week. It has to do with what I call the themes of a trade. Every trade, regardless of which trading discipline you're involved in, day trading, futures trading, options trading, each trade strategy has its own theme, meaning there's a condition under which that trade will shine, and there are conditions under which that trade will not shine, will lose. And if you are trading a particular strategy, you can tweak it and play around with it. Obviously, all experienced traders do. But to completely abandon the theme of the trade is usually not a good idea. So let's first talk about what I mean by the theme of a trade. Those of you who are options traders know what an iron condor is. It's a sort of a wide trade within a wide range of the market. The iron condor, all other things being equal, should win. And so that will do well in a channeling market. A long straddle, on the other hand, where you have let's say an at-the-money long call and an at-the-money long put, that's going to do well in an environment where volatility is very low, and then for some reason it picks up, and or there is a big, very big move in the market when the market was otherwise sort of stable. So that's the theme of a long straddle. The theme of a bearish butterfly, which is the subject of today's video, is the fact that the market always, at one point or another will rally, and at the end of a rally is a pullback. And therefore, a trade that's set up to take advantage of the pullback will normally do well in the pullback. And so that's the theme, more or less, of a bearish butterfly, which is one of the strategies that we trade on our trading desk and we sell within our education business. So each trade has its own kind of rationale, its own kind of theme, its own kind of conditions, in which it will work best. So what's the importance of this? The importance of staying within the theme of the trade will be exemplified by the following example. So we had a trader on our desk who I was working with this week, and he was trading a bearish butterfly. And so in late August, the trade looked something like this. This is a typical position for a bearish butterfly. It's a butterfly structure set up behind the market and waiting for that pullback we just talked about. So this would be sort of a normal structure for a bearish butterfly. Now, in early September, this trader tweaked it a little bit, which he's very good at, and he turned this into still a bearish butterfly. You can see it is positioned to take advantage of a pullback, but he does do some hedging to the upside, and also the trade kind of expanded because of the natural build of capital into a bearish butterfly. So the shape, so to speak, of the trade is a little bit different, but this is within theme. In the pullback, you will cash in on the bearish butterfly. In the rally, you'll be struggling. And so that is where this was one day before the big sell-off, which occurred on September 9th, I believe was the date. And so the market right before that sell-off was grinding up. And you can understand any trader trading a bearish trade that you'd start to get perhaps a little impatient. You'd start feeling like this market's going to grind up forever. The SPX, basically the last couple months of the summer, was as flat, almost historically flat. The Russell 2000 was grinding up, but in any event, both the SPX and the Russell got very, very low volatility during the summer. So those are the kind of conditions that are not very good for a bearish butterfly, and you can understand someone getting impatient. But what's not a good idea is to leave the theme of the trade completely. And what this trader did the day before the big sell-off was to restructure the trade into something that's more like a condor. He put a call butterfly up on above the market. He had the bearish portion of the butterfly on the put side. It's still there, but the call butterfly above the market was, made the trade only in a position to be able to make money if the market basically kept starting to grind up, or maybe a small pullback, but certainly couldn't handle a sizable pullback. And so guess what happened? The day of the pullback, the market pulled back too much, and what was all month going to be a trade that would make money upon the pullback ended up actually being the day the trader had to exit the trade for a reasonably sizable loss. And to make matters worse, let's take a look at what would have happened if the day before he made this theme-changing adjustment, he had just left the theme alone. He would have been able to close the trade at a really nice profit the next day. So because you start getting into a mindset the market can never sell off anymore, it's just going to grind up or stay flat forever. Once you get into a mindset like that, sure enough, the market does exactly what you think it's not going to do. And so this was a really good example of leaving the theme of a trade. He went from a bearish butterfly to sort of this condor structure and did not allow for the possibility of exactly what happened, which was a strong, high volatility sell-off that occurred the next day. So let's talk about the moral of this story. And the moral of this story is this isn't a biblical rule. This is more like a best practice. It's the kind of thing that very good traders will tend to do, which is they stay within the themes of the trade. And what are the advantages of staying within the themes of the trade? Well, first of all, if the trade is like a bearish butterfly, which is a high risk, high reward trade, if you transform the trade mid-trade to something that's low reward and maybe arguably low risk, but certainly low reward, the math during the year doesn't add up, because if you're going to take some max losses once or twice a year, you've got to also have the great high reward wins as well to balance those out. But if your losses are all max losses and your wins are all very mild wins, the math doesn't work. It's going to be a losing strategy. So for one thing, you've got to stay within the risk-reward dynamics of the trade itself to make it work long term. Secondly, when you do change structures, there's a tendency to start improvising after that, because basically you're in the wild, wild west. You had a nice, neat, well-designed strategy. Now you've altered it, and if certain things happen, it'll turn out okay. But if those things don't happen, what do you do then? Well, you haven't backtested. You don't really know what to do then. You start improvising. And most traders I found who are improvising without the backing of solid backtesting usually do not do very well on the trade, at that point. So that's a second reason. And the third reason is that oftentimes people have what I call a portfolio of trades. They'll have 3 or 4 trades they do every month, and each one has its own place within his portfolio of trades. You may have a balance where some of the trades are positive vega, the other trades are negative vega. Some trades do well in a pullback, some trades do well in a rally, something along those lines. Well, when you change the fundamental nature of a trade and you leave its theme, you've also created an imbalance within your portfolio of trades. So think about that. Your whole theme, why have a portfolio that's balanced if at any time during the trade you can throw that balance off? And so for all those reasons, it's a good idea to stay within the theme of your trade. If you intentionally, if you backtested it, if the trade's designed to create a certain balance in your portfolio, if there are scenarios where it will work very well, you don't know whether those scenarios will unfold or not. You don't know. None of us knew there was going to be a sell-off that day, but all of us should have known there was a possibility of a sell-off that day, and that's because every day you flip your computer on, the market could be in the midst of a sell-off. It could happen any day, just as a big rally or a mild sell-off or a flat day. All those scenarios can happen on any given day, and therefore you'd need to be prepared for those. So stay within the theme of your trades. It's a good practice. It's the best practice of top flight options traders. They stay within the themes of their trades. They don't get impatient. If it's not the winning month for that trade, it's not the winning month. You anticipated that. You knew that. You knew going in you weren't going to win every month. But if you leave the theme of your trade, then you're going to find yourself running into problems most of the time. So I hope you take that to heart. Think about the way you're putting your portfolio of trades together, and that way you can be a long-term successful options trader. Thanks very much, and we'll see you next week.